Hello, everyone. Welcome to today's session. Let's get underway. Market conditions bullish in this bull market, still the upper end of this range. Bull market rank at 26.52, and still continuing to hover in that, really in that stratosphere, just way up in this current market condition right here as we've been rallying. This is the 20-year perspective. This is the 1-year perspective, and we are just at that area where we have not been this high before, really in all-time highs. Market conditions are high. S&P is at all-time highs. Prices at all-time high as well. So we'll talk a little bit about that today. We've really been talking about this all year long, as this is an area where we could see a blow-off top, or we could see any little thing that might hiccup with economic numbers or employment numbers really could drive the market higher or lower at these levels. Let's look at some of the technicals here. Buy-sell ratio sitting right at 1.39. They had widened out a little bit, now starting to curl back together again. Bulls still in control right here. So as far as adding up the evidence towards continuation of the bullish trend, we're in this. We've got buy-sell ratio that's moving higher. We're green above red. We are in the shorter term curling back as we have had this big run up on S&P 500. Sentiment is also at the upper end of this range. So when we look at this chart, let's go out maybe 3 years. Maybe we'll pull in a few different perspectives here. 3 years is when we get to these levels. This was the high point was 94 on the 8th, and back here we had been at 89. Back here we had been at 96, and so certainly elevated levels across the board. This is just not sustainable. It doesn't necessarily mean we're going to get an entire reversal at this point, but it does mean that the market could be tired, could be due for a little bit of a rest right here. S&P 500 really displaying that a lot better in terms of a quick run up from here to here based on election results. Now we're kind of topping out and just working on this sideways consolidation. That's constructive. We have now gone from this extreme back into this bullish zone, this buy zone, and it's still within the overall uptrend. So these actually are creating a little bit more demand, or a little bit more area for demand to accumulate, and we're not seeing real aggressive selling at these levels either. So the quiet consolidation phase is healthy at this point. Even though we are at these all-time highs, we could certainly go higher, and we want to continue to ride that trend as long as it lasts. We want to make sure that we're allocated properly. That's the biggest factor anytime we're going into any type of a trade or portfolio management, is the risk management versus being 100% invested. Now, risk management is a very individual thing. So when we're talking about risk and we're dealing with portfolio sizes, there is some structure to be able to use, but you've got to be able to then implement that into your own trading plan and into your own financial suitability. Also within your own ability to manage a portfolio and manage trades. Things can happen quickly, things can move quickly. So, and trading individual stocks and owning individual stocks, making sure that that risk parameter is set up in advance so that you understand what the risk is that you're taking. There's two different types of risk. We'll talk about that a little bit more today as well. Market risk and then individual position risk. Okay, let me go through this current market condition still, and we'll jump into that. So S&P 500. So part of the value of this perspective right here is we can kind of get a quick idea of really the quality of the rally, and so we know that when we have these risk-on scenarios, then we get money dumping into smaller cap names, tech names, Russell 2000, Russell 1000. These are smaller market cap companies which theoretically have more risk. Again, all stocks have risk. There's no such thing as a safe stock because it's driven by a marketplace. It's driven by an auction, buyers and sellers, and they're all linked together. All of these individual stocks are linked together now with all of these indices. We have these passive funds, even like the ETF SPY right here. But we've got Vanguard, S&P 500 fund. There's so many index funds now that anytime anytime a market moves, anytime an index moves, any stock in that index is going to move. So whether it's a good company or not, the stock could be wildly volatile. So we want to make sure that we are not equating the quality of the stock to the quality of the company, because typically that does over time it matters, but in the short term it doesn't matter, because you do get volatility in any stock, and depending on the market conditions, if things have been bid way high and there is some risk for sell-off or profit taking or an earnings miss or anything else, then any stock can drop. So just be aware of that. This is the current situation right now. We know we're S&P 500. We've looked at that right there. We know Russell 2000 had a big move, working on this retracement, leading the way up, leading the way back down. We had that same story back here. This actually was a tougher scenario when we're trading momentum trades. This is not what we want to see when we have momentum and then we have a really deep move this direction that either stops us out of a lot of positions or forces us to reevaluate, and then we get the move back into momentum. So oftentimes this move right here, we miss out on some things while things are generating new trends. And so the really sharp volatility is really not conducive to good momentum trading, and that can happen. You just never know exactly what you're going to get out of a market, and so we have to make sure we're managing risk, we're managing portfolios, and managing position size as well. If we jump over to bonds are still part of the conversation. We're still talking about interest rates. We're still talking about inflation. We're still talking about even potential recession at these levels, and interest rates are key to that. We've talked about that for several months, and I'll continue to go over that. Remember, one of the things that we're dealing with and we're focusing on is we're dealing with a bond yield curve that has been inverted. It's starting to flatten out just a little bit, and again, just as a reminder, interest rates really control the amount of money that's in the system, the ability for companies and consumers to borrow money, and the more expensive that money is. If interest rates are higher, it's more expensive to borrow money. If I can borrow money at 2.5%, I'm paying X amount in monthly payments to borrow that money. If it jumps to 5%, now for me to borrow that same amount of money, it's doubled the cost of that money for me to borrow. So I may borrow less money, and that's the same thing with institutions as well. They may be like, we're going to hold off a little bit on this growth that we were going to do based on issuing new bonds or whatever the debt component is going to be. For them to raise that money, it's going to be linked to interest rates. So we've got a flat yield curve now, and just to go back to what we want to see, this is a healthy yield curve where the short end of the yield curve is lower, the interest rate is lower, the long end of the yield curve, long meaning it's a 30-year interest rate, short meaning it's a 3-month treasury note. So those are shorter term in duration, the amount of time before that expires. And bonds typically have either a coupon or you get paid at the end of the duration. So the longer you're forced to tie up your money, you would expect, if I'm forced to tie up that money for a long time and I'm not necessarily going to earn interest on it until that time period, then I want a higher interest rate, versus if it's only a 3-month time frame, I'm going to get a shorter interest rate. So as the bond yield curve starts to adjust, this is what happens to that short end of the yield curve. It gets more expensive here to borrow that money. Now, because of COVID interest rates were basically flat. We had a healthy yield curve, but it was next to nothing. The interest rates were zero or flat, so it was very easy, basically, just to borrow money almost for free. And so you had a lot of money flowing into the system that creates a lot of money chasing fewer and fewer goods. The value of those goods is going higher and higher. That's food, that's energy, that's housing, that's cars, that's you name it. And this last run, everything went higher. We had massive inflation. That seems to be back under control, near 2%, which is good. And we're also seeing the bond yield curve, if you notice the short end of that yield curve, starting to come back down a little bit. Really the middle of this yield curve and the short end of that yield curve both coming back down again. And so we're seeing some constructive activity here in the bond market, which is good. And we're not seeing, we've had several economic numbers, we've had several inflation numbers, and the CPI numbers, some labor numbers. Those are some of the numbers that the markets are going to be paying attention to right here at these levels. Let's jump over and look at sectors right here as well. We've seen sectors which are also just giving some confirmation to that current bias of bullish. A little bit more, we don't have really strong across the board. We've got a few that are in downtrends, a few that are transitioning, and the majority still in uptrends right here as well. And that's what we want to see. Commodities, we're continuing to see some weakening here. SLV showing weakness and GLD showing weakness. So that commodity move pulling back. We're seeing Bitcoin running higher. We're seeing stocks moving higher. We're seeing tech stocks and small caps moving higher. So there is some there is additional risk taking in the market right now. So that's what we want. We want to be paying attention to what are some of the cues that the market is giving us. Now, in terms of risk and allocation, I wanted to go over a couple of different things here in with regard to individual stocks as well as these sectors. Now, when we talk about these sectors, we've talked about this before, and that is if you're feeling, depending on this individual trading of stocks, if you're feeling like that's just, I don't know which stock to buy, I don't know, I'm having a hard time focusing on one or two because there are so many to choose from. One of the ways to get around that is to choose a sector ETF that is leading, and then you're owning a bunch of different stocks inside of that one ETF. So if you were buying a stock and say you were allocating 2% like we typically do, maybe you go up to still around that number, but maybe you go a little higher, maybe you go 3 or 4 or 5% allocation into one of the leading ranked ETFs like financials or consumer services. They're going to be adjusting, obviously, and be moving lower and higher. So when we're talking about those, and maybe you're looking at healthcare, and you're saying, well, okay, I want to look at healthcare, but it's in a downtrend, or what is leading? This can also give you some indication of should I be focused on that sector or not. So we're seeing a lot of healthcare, the healthcare industry or sector as a whole starting to move lower. So with this particular ETF, we can look and see, well, what are the stocks that are inside of that ETF? If we go out to Yahoo and look at the individual holdings on this ETF, click on hold, and we can see in that health care ETF symbol, it's an iShare, IYE. We've got Eli Lilly, we've got United Health, Johnson & Johnson, Merck, Abbott Labs, Intuitive Surgical, Amgen, Pfizer. These are the who's who of the massive healthcare stocks. So if you want to own this entire group, then this would be a way to be able to do that. Now, you can also say, should I own that entire group? And you can see right now, no, probably not. It's continuing to trend lower. So you can own that entire sector or own that entire group, still the exact same way we focus on individual stocks in momentum, but you're just owning a larger group of that. So that's the same story here with ETF, the muscle ETFs. You're getting a lot of variation in here, though. Now they've got an ETF for just about everything. You can get 2x of NVIDIA. You can get 2x, negative 2x, positive 2x. You can get leverage. You can get just about anything now in an ETF. So right now you're seeing a lot of these blockchain. You're seeing crypto. You're seeing Bitcoin come to the surface in ETFs. So ETFs are a great tool to be able to utilize if you don't want to have to worry about which individual stock should I own. I want to own an idea. I want to own a thesis, so to speak, and that is I like blockchain. I like banks. I like crypto. Okay, well, what should I buy? Should I do this? Should I do that? Instead of having to focus on one or two, you can focus on an ETF, which is going to give you some diversity among some of these different ideas as well. So get familiar with that. ETFs are really a great tool, particularly if you're newer and the volatility is stressful or frustrating, or you just want an idea. You want to invest in an idea, a larger idea. And that, what I mean by that, by an idea, is I want to invest into financials, or I want to invest in consumer services. Then I could buy, these are some of the leading stocks right here. U.S. Consumer Service iShare ETF in momentum, moving higher. Could use a pullback because it's up to this extreme level, still above the 236 location. And here, then you could go in and say, well, which are the individual stocks in this particular ETF, and see which leading out of that group. Okay, and I wanted right. You've got Amazon, Tesla, Home Depot, Netflix, Walmart, Costco, McDonald's, Disney. Okay, these are amazing companies. These are not, they're not. They may not be the most high flying, high performance like a muscle stock or a mid cap or small cap stock, but if you still want to own just the idea of consumer discretionary and you're getting all of these in one basket of stocks, then you can buy into that sector. Okay, managing it still the same way, managing it ideally based on a location here where you've gone from hold to buy, and you're looking for continuation of that momentum, or looking for an opportunity for it to pull back from extreme back into the buy zone. Those are areas to be paying attention to. There are also inside of the muscle ETFs, you can go to the new buy list. There's nothing actually in there. If it ever shows up blank like that, it means there is nothing. The ETFs, you're going to get a lot less. There are not as many. So you may get some of these scans that are showing up blank because there's nothing that have met those criteria for that day. Versus the muscle stocks, there's so many more stocks and there are ETFs that there's almost always something in this list at this time. Let's talk about that right here now. Again, market conditions. Again, going with that top-down approach. The real long-term perspective is: are we in? Are we in for a turn? Are we in for a bear market? It's always hard to tell the future. Nobody can do that. But what we have to do is we just have to kind of pay attention to what is some of the evidence that we're dealing with, and market conditions. We know they don't go up forever. We know that they get priced to perfection or for perfection. We know that when that perfection doesn't pan out, you're dealing with an auction. You're getting buyers and sellers. When you have more sellers than buyers, it's going to turn. And those sellers could be selling for a million different reasons. The company is not performing. Their profitability has gone down. They're guiding lower. The economy is slowing. You've got that market risk. That's what I mentioned talking about earlier. The market risk of a portfolio is if I'm owning a portfolio of stocks and I own this group of stocks, this group of leading stocks, and this is some of the current holdings that we've got right now, then if the market were to retrace, there is a possibility that all of these can also retrace. So just because we have a stock that's moving higher and the market starts to move lower doesn't mean that these stocks also can't move lower. So market risk is when the market retraces, the entire portfolio can retrace, okay, and have some volatility, versus equity or individual holding risk, and that is, what's the risk of this one stock that I'm taking? Well, okay, this one is just about to get stopped out. It's had a decent move lower. That's an individual holding risk versus the market risk. So there's two different types of risk that I'm always having to take or deal with or manage, and that is your individual holding risk as well as the market risk that you may have. So to deal with market risk, we deal with position size. How much cash do I have versus holdings? Okay, right now it's right around that 25%, and it has been there most of the year, and that has affected performance a little bit because of the size of the positions. Okay, but that's okay, because in this portfolio we're not necessarily trying to swing for the fences on every single trade. Neither should you. That's about, that's where you start to get into trouble, is the expectations. I know that marketing out there is all, there's all kinds of fun examples of things doing amazing things, and that all of those possibilities are there, but there's risk. There's a certain amount of risk always associated with those potential rewards as well. Just like this 100% gain on PLTR, it is a fraction of the portfolio. Okay, so the overall gain, yes, we didn't participate in the full 100% in $100,000, but we did participate in 2 to 2.5% of the holdings, and that allows us to deal with some of these. That allows us to say, well, some are going to win big, some are going to lose. These losers we typically cut. This is getting very close to a stop out level. Typically, we're not. When it gets to that 10 to 12 to 15% location, we're going to stop out, because ultimately we need to keep our our losers small and let our winners run. And we continue to hold on to those winners as long as they're working. But they are subject to market risk. So if the market decides it's going to roll over, then these stocks that we do have are going to they may perform better or worse, but they're going to be volatile with the direction of the market. That's why it's important to be in the direction of the market and understanding that as well. So just a little bit of perspective. That's kind of macro perspective portfolio management as well, because a lot of times it's like, well, which stock should I buy? How much should I buy? Should I own 100% of that stock? Should I just plop 10,000 into it and not know any idea about where my stop loss is, or what are my targets going to be looking like? All of those things are questions that can be answered with a trading plan. And that trading plan is, well, I'm going to do 2% or 2.5%. I'm going to have my stop loss in place. So let's go through that process here a little bit. We've got a couple of stocks here we can look at. We can look at RNA. Let's see if there's anything else. If we go through and we go with, I want to go into the new buy list. So these top two, RNA, ASTS, typically we want to wait for it to get up into this momentum zone. Sometimes you can see that if it doesn't, there's a lot of resistance right there. It can hit that resistance and potentially continue that move lower. It happened right here, but it's working, increased volume. It's trying to get back up into that zone. So let's look at this one and say, let's take a trade on it, right? We obviously don't know the future. This is what we know as of today. We know where it's been. We know where it's at. But what we don't know is where it's going. Okay, is it going to go here? Is it going to go here? Is it going to go here? We don't know that. But what we do know is what the trend is, what the momentum is doing, and it's carrying it this direction. It's trying to break back up into this zone, and not quite there yet, but it's a high demand name, and there's some interest in it. It's priced in that $20 range, which a lot of traders and investors like to focus on there as well. So in this case, I can do a couple of different things. Let's go to, in terms of my allocation. If I wanted to buy this stock this morning before the market opened, this would be what I would be looking at. I've got to make a decision based on this information right now. Okay, that's all I've got to deal with, at least based on this methodology, right? What we're looking for primarily, we're looking for stocks. The scan is going to pull the cream to the top based on rank. So the muscle stock scans are sorted by rank. So it's going to pull in anything that's got a high rank means that it has been performing really well up to this point. In fact, let's look at this stock here, DDL. Okay, so new big uptrend from $2 to $4. It's kind of a DoorDash type company in China. This is an ADR, which means an American Depository Receipt, which means it's a foreign stock trading in the U.S. We trade the ADRs versus the stock itself. Still works just the same, and you can profit essentially from a foreign company. So if you have issues with that, don't trade it. If you don't have issues with it, then this is a way to be able to trade it. I thought there's an interesting name, Ding Dong, for the doorbell, kind of like the DoorDash type of idea. A lot of interest. You're seeing all of these big moves here, also on big volume, and a lot of volume coming in during this rally higher. So you're getting a lot of institutional interest in that. That's what we want. We want stocks that have institutional interest, and any stock that is moving higher like this with an average volume of 2.5 million shares has institutional interest. Nobody, our 100 shares or 200 or 300 shares are not going to make a big dent, obviously, in the direction of it. But as more and more people find out about this stock or stocks like it, then that can have a nice rally. Let's look at this scenario here. Okay, so here's a new buy. It's in momentum. I've got to determine, again, my two components of risk are what's my position size, the number of shares I'm buying. It's a $4 stock. So let's say 500 shares puts me at 1.74. Let me highlight that right down here. 1.74 at risk. That may be too low. That may be too high. Depends on what you want for your trading plan. If I went up to 700, puts me at 2.43, too high for my liking. 550. Let's go 600. 600 puts us right at 2%. Now, I can place my stop in a couple of areas. This low point, okay, this is called a confirmation bar. That confirmation bar just says it's moving higher, and it's moving higher on increased volume, which is confirming the fact that there is demand for this stock at this location. Okay, we're getting confirmation that that there is still demand for that. Okay, it's a confirmation bar allows us. It also sets up a potential risk profile. We can use that bar as the amount that we want to risk if the entire bar were erased. If we bought it today and it immediately reversed and dropped below that bar, then that's our stop loss location, and we would stop out of the trade. So that's a great place to do it. If you get worried about, I'm going to get stopped out prematurely, or I don't want to get stopped out, that's a frustrating thing, but it's not the end of the world. You can always buy back in. The more important thing is your risk. How much risk are you taking? Because not wanting to get stopped out and moving and having a stop in the wrong spot is not the right reason for placing a stop in a certain location. The stop needs to be placed based on your risk level. So if I'm setting a stop at this low point, okay, so my low point is right here, and that low is 385. I'm looking over on this, 385, and I put that stop price in, $3.85. That gives me a risk per share of 7%, $174.15. So I'm able to take a full allocation meaning almost my 2.5%, between 2 and 2.5%, and I go 3.85 or 3.80. Can't remember what I said now. Then we can go with that. If you wanted a wider stop, okay, we actually got stopped out of this stock on this day because we bought it here. It rallied up. We had adjusted the stop loss, and it traded back. It was a pretty volatile day right here. I believe that was the election day. It traced back, stopped out, and we actually are re-entering into this at this location. So it's a good example to be able to utilize. But the stop's a little bit deeper. So we can go deeper. It doesn't necessarily mean we won't get stopped out, but it just means that the probability of it moving back to a zone that is still bullish, that's still support, and there's still demand right here, and then it rockets higher, that is frustrating when you get stopped out and then it immediately reverses and heads the other direction. But the more important thing is this number. Okay, and that is if that's okay. We don't want to just not put a stop loss in place because we hope that it's going to go higher. That's asking for disaster, particularly on these kind of stocks. These stocks can move up 20% and down 20% in a day, and we want to make sure that we're managing that risk accordingly. So in this case, I can determine my stop level here. I can determine my stop level a little bit deeper. If I wanted to go down to that 345, let's say I went all the way down to 340 on this one. Okay, now you can see that put my risk number too high. We went from $175 at risk to $414 at risk, 0.35, just by lowering our stop all the way down to this low instead of this low. Okay, so we can manage that. If we want to keep our stop this deep, we can manage that by the position size. Okay, if I went down to 400, you can see this number is now dropped. If I went down to 350, I'm at 0.21. Okay, so now I have a smaller position size, but I have a really wide stop loss. That's a more conservative way to trade in stocks is smaller position size, really wide stop loss. Okay, if I get rid of that, now you can see we're at 0.12. So we don't have a very big position, which means our upside will also be limited, but we're managing the risk. There's a direct correlation between the amount of risk I'm taking and my potential reward. I can't get one without the other. Okay, so if I want more of the potential upside, I have to take a bigger position. And if I want a bigger position, then if I went back up to 600 shares and I'm at 2%, then I've got to place my stop loss someplace else. Okay, I've got to have it in a location. In this case, if I went 360, that's at 0.25. That's less than my 0.30. It's between that 0.2 and 0.3. That would be an acceptable number. Okay, so as you're going through these exercises, really you can buy any stock at any time for any reason. this is honestly the most important part, is the risk management. The entry, obviously, if we can get the right location, that's going to help where our stop is going to be placed. So if we're getting into a bounce at this support 236 area and we can set a tighter stop right here, it shouldn't drop below this low. But if it does, we've got a tight enough stop that we can manage that, and we can always re-enter, right? Okay, we can always re-enter the trade. We don't have to be like just lower our head and our tail between our legs and saying, oh man, I can't figure this thing out, this stock, this thing, I'm never trading this again. Whatever it is that we have for our self-talk, believe me, I think we've all done this 1,000 times. If we've been in this world for any length of time, then you're having a lot of self-talk, self-doubt, deciding if the decisions that you're making are good or bad or whatever the case may be. Okay, so the important part of that is creating a structure so that you know what you're doing each time, and more importantly, you know what your risk is each time. I'm going to end on that note. Appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Have a great weekend.